The business model of an insurance company. In the insurance world, there is so much to learn and explore, which can be a very, very big deal.
Risk acceptance and diversification are the cornerstones of insurance firms' business models. The fundamental insurance approach involves combining the risk from several payers and distributing it over a broader portfolio. The majority of insurance businesses make money in two ways. First, by charging premiums in return for insurance coverage, and second, by reinvesting those premiums in additional assets that yield interest. Insurance companies strive to market efficiently and keep overhead to a minimum, just like any private business. Health insurance firms, property insurance companies, and financial guarantors all have different revenue models. But any insurer's first job is to assess the risk and set a price for taking it on. Consider the case where the insurance provider is promoting a policy with a $100,000 conditional payoff. Based on the duration of the insurance, it must determine how likely it is for a potential buyer to trigger the conditional payment and increase that risk. In these circumstances, insurance underwriting is essential. Without sound underwriting, the insurance provider would overcharge some clients while undercharging others for assuming risk. The least risky customers can be priced out as a result, eventually leading to a rise in rates. Effective risk pricing should result in an organization earning more money from premiums than it does from conditional payouts. Global Institute for Risk Management underwriting. In a way, insurance claims are the genuine product of an insurer. The business must process claims from customers, verify their accuracy, and submit payment. This adjustment procedure is required to rule out fictitious claims and lower the company's risks of suffering a loss. Let's say that $1 million in premiums are paid to the insurance provider for its policies. It might keep the cash on hand or put it in a savings account, but those options are less effective. Those funds will, at the very least, be subject to the danger of inflation. Instead, the business might invest its money in secure short-term assets. As a result, the business generates more interest income while it waits for potential rewards. High-grade corporate bonds, treasury bonds, and interest-bearing cash equivalents are examples of common products of this sort. Reinsurance is a strategy used by some businesses to lower their risk. Reassurance is the insurance that insurance firms purchase to safeguard themselves against disproportionate losses resulting from significant exposure. Reinsurance is essential to insurance firms' efforts to maintain their financial stability and prevent payout-related defaults, and regulators require it for businesses of a specific size and kind. For instance, based on models that indicate a minimal likelihood of a storm affecting a geographic area, an insurance company may write excessive amounts of hurricane insurance. If the unthinkable occurred and a hurricane did strike that area, the insurance firm might suffer huge damages. Insurance firms might run out of business every time a natural disaster strikes if reinsurance doesn't take some of the risks off the table. Unless it is reinsured, regulators rule that an insurance firm can only offer a policy with a cap of 10% of its value. Reinsurance enables insurance companies to transfer risks, enabling them to be more aggressive in capturing market share. Reinsurance also smooths out insurance firms' normal swings, which can result in considerable variations in earning and losses. In many ways, it resembles arbitrage for insurance companies. They charge more for insurance for individual customers, but when they insure these policies in large quantities, the prices drop. Reinsurance makes the entire insurance industry more suitable for investors by reducing business fluctuations. Like any other non-financial business, companies in the insurance sector are rated according to their profitability, projected growth, payout, and risk. However, there are additional difficulties unique to the industry. Due to the absence of investments in fixed assets by insurance companies, very little depreciation and very little capital expenditures are reported. Additionally, since there are no traditional working capital records, figuring out the insurer's working capital is difficult. Instead of focusing on equity measurements like price to earnings, PE, and price to book, PB ratios, analysts do not use metrics that take into account firm and enterprise values. To analyze the companies, analysts perform ratio analysis by computing ratios that are specific to the insurance industry. Insurance firms with high projected growth, big payouts, and little risk typically have higher PE ratios. For insurance firms with strong projected earnings growth, a low risk profile, a high payout, and a high return on equity, PB is greater. Return on equity has the biggest impact on the PB ratio when all other factors are held constant. Analysts must contend with additional complicating factors when comparing PE and PB ratios across the insurance industry. Insurance providers budget for potential claim costs in advance. The PE and PB ratios may be excessively high or low depending on how careful or aggressive the insurer is when assessing such provisions. Comparability throughout the insurance industry is further hampered by the degree of diversification. Insurance companies frequently operate in one or more different insurance sectors, such as life, property, and casualty insurance. Insurance businesses have varying risks and returns depending on their level of diversification, which affects their PE and PB ratios throughout the industry. Long ago, when merchants worldwide used to travel between countries for commerce and business, the insurance concept and industry began to develop. Utilizing waterways was the most common and economical mode of transportation. Stocks and inventory were transported via boats and ships. But frequently, ships carrying cargo were sunk, taken by pirates, or lost. Therefore, a group of 10 merchants or business people sought a risk-bearing strategy in light of the loss, as mentioned earlier, of merchandise and boats. Each of them gave 10% of the inventory or stocks as a solution, and the same was gathered in a bag. After each business member had contributed, there was enough money in the bag to cover any shipowner's losses, whether they were financial or emotional. Therefore, this behavior by the merchants is seen as commercial insurance because they were jointly insuring the risk by pooling funds, the premium, and they also provided that money as compensation to the merchant who experienced a loss, the sum assured. Insurance providers offer a variety of insurance plans to cover different unforeseen circumstances, enabling both organizations and individuals to carry out their everyday operations without difficulty. By offering stability and mental tranquility, these policies eliminate the chance of any significant and unaffordable loss in the future. Additionally, the losses of a small number of people are shared by many. Insurance firms provide a variety of insurance policies to cover a range of risks, including those related to homes, lives, cars, and health, among others. Businesses and corporations can also benefit from a variety of insurance plans like workers' compensation, property insurance, group medical claims, group personal injury insurance, fire insurance, etc., to protect the interests of their employees and corporate assets in difficult situations or unexpected losses. Customers' risks against old age, death, illness, disability, etc. are covered by insurance firms. Along with essential insurance products, they offer several extra advantages or services geared towards risk reduction, efficient claim processing, etc. This also involves giving advice on topics like cybersecurity or health. Insurance companies provide a variety of retirement savings options, including pensions. The majority of the products that insurance firms offer are combinations of investments and protection from various dangers. Customers benefit from both profits on investments and life risk protection as a result. The products of insurance firms have minimum returns that are guaranteed. That's all for today. If you liked this video, please give us a thumbs up. Make sure to subscribe to our channel and hit the bell icon to receive notifications. Also, express your valuable thoughts in the comments section below. Until then, bye!